last week we had a discussion, and with the coaching sessions and the other webinars I put together this week, I didn't have time to re-put together the question that came in at the end of Friday. And it was related to the long option finder and the effect of implied volatility. And because of that discussion, I had an NEGG, which I think is at a $9 stock or so. I expected. Let's say if I expect it to move up close to 20%, up to 11, and I was going to put $1,500 into options, and I expected to do this towards the end of February. Let's do the 22nd. I don't think there's any weeklies after that. I could be wrong. Perfect. Okay. So here's NEGG priced at around $9. I'm telling the system, if I expect it to move up 2 points with $1,500 invested in the position, and I expect it to hit around February 22nd, what this tool showed me are which options would give me the best theoretical return if the stock hit my target price on my target date. And with stock at $11, it pulls up the May 10 call, which I could buy right now for a price of 202 and has an implied volatility of 1.06, pretty high. Well, if I bought 7 contracts at 202, that'd put me at 1414. And if the stock is trading at $11 on February 22nd, my May 10 call would theoretically have a price of 269 for a profit of 33%. Wouldn't I expect a higher return with a long call if the stock moves up 20% in about a month and a half? Yeah, but you're overpaying so much into this option. It's 133 days out in time. Why am I only seeing the May series? I did that specifically because I chose the February 22nd date. If I chose February 17th, it'd be showing me higher returns for standard February expiration. But the only series that's available in NEGG after the standard February expiration are the May and the August options. They're far out in time and relatively expensive. But the main question, and I thought I had written it down, I forgot the gentleman's name that asked, the main question is this return going to be affected if the applied volatility reverts back to a regular range? And the answer is yes. And you can view that on this page. So if I'm looking at this position on NEGG, which has a high implied volatility right now, one thing that I want to check first on this May 10 call is the total implied volatility range. So we're going to go to the research. We're going to go to option research. And in this case, I see that the implied volatility is 1.06. But the percent IV range, well, it says from 0 to 1.306. Likely, let's see here, before that triggered, probably on a bad day of data. Where's my implied volatility? It's in blue. So just going back here to 919, where's, oh, at 0.8, 0.75, that seems average. It dipped down here at the 0 at 1 point, 0.59, 0.79. Okay, so I'm going to call it 0.8, looks like the mid-range implied volatility of where this option has been from about 0.5 to about 1.3. Actually, it's probably about 0.9, but we're going to use 0.8, okay? And what am I saying? I'm saying if some event comes up, maybe they're planning on earnings, maybe this is inflated for some reason of that, or maybe this is just a big volatile stock, but I'm expecting an event that could lower the volatility. Is this going to be affected, this return, for this May call that looks like the best bang for my buck if the stock does hit 11 on February 22nd, but if the volatility changes to 0.8, reverts back to its norm, it's not even on the list. Oh, there it is. The May 10 call would now only have an 8% return. It wouldn't be worth $269 on February 22nd using an implied volatility of 1.0629. Using an implied volatility of 0.8, it would only have a value of 218 or a return of 8%. So to answer that question, yes, you want to run those different implied volatility numbers, not only on this tool on the long option finder, if you're looking at things with a high implied volatility, but also if you're evaluating the profit and loss chart. And I want to say, okay, here's my profit and loss chart on the position. But if I expected the stock maybe to hit around $10 sooner than February, say February 3rd, what could my return potentially be? And here we have it here, it'd go up to 226. But what happened if it goes up to 10 from 893 and my implied volatility drops to 0.8? I'm at a loss. The very important thing to use here on the profit and loss chart, especially when you're evaluating calendar spreads or diagonal spreads, because you want to look at the long and short option. And again, you want to make sure that if the implied volatility of your long option shifts after an earnings or some other event, you see an IV crush, how is that going to affect your trade? And this will show you that directly. So again, when using the long option finder and you want to evaluate how much would an implied volatility shift hurt my position, go first to the option research tool. Once you see the long calls or long puts that would have matched, giving you the best bang for your buck based on your target for the stock and your target date, go to that options research tool, take a look at the implied volatility range here. What would happen if I fell back to a norm of say 0.5 or 0.6, then go back to the long option finder, change that volatility and see how it would affect the position. In this case, it shows that the August 7.5 call would give us the best return of 19% if all the options fell from this 1.06, 1.2 range down to 0.8 as well. All right, that's going to help you with that scenario. That's the better presentation I wanted to get together. That I accidentally froze the screen and then I couldn't find a good example with all the weeklies because it kept just pulling up the weekly options that were trading at intrinsic value. I needed to bump it out a little bit further to go past the last standard expiration.